we have our final panel session of the day. It is on venture investing in a recession. So here joining us, we have Rod Bristow from Investible, Jeb J.A. from Clearglass Capital, Jenny Morel from Morgo, and Karen Chan from Perennial Partners.
On? Is this on? Okay, so we can't really see you because of the bright lights, but hopefully you can see us. So I'm Jenny Morel, and I'm an old friend of Steve Torso and an investor in Wholesale Investor. My background is that I started the first of US-style venture fund in New Zealand, Number 8 Ventures. We ran 2 funds. The second went through the 2008 recession. I know all about what happened to pre-revenue companies at that time. We survived. We listed a few companies. Phew, that was hard. I'll leave it to the next generation of VCs. But what I do these days is I convene a community of CEOs of tech and other high-growth companies going global called Morgo. We have a signature event, which is a 2-day get-together in Queenstown in a few weeks' time. We do podcasts. And yeah, I've continued to be very active working with tech companies. So that very quickly is from me, and I'd like to pass across to the panel to introduce themselves, and I will take a seat. So why don't we start at the end, Jeb?
Sure. Thanks, Jenny. I do feel like I'm being pulled over by the police like I usually am for speeding with the bright lights on me, but all good. My name is Jeb Altanaga. I run Clearglass Capital. I relaunched it last year to expand services to include capital raising across venture, PE, and public markets across North America, the UK, Switzerland, and North Asia and Australia.
Hey all, so I'm not Rod. So Rod's the CEO of Investible, and what do you do when you're the CEO? There's 2 hours left and you can't make it. You send the analyst. So that's who I am. So I'm the analyst at Investible on their climate tech fund. So we're a $100 million fund investing in pre-seed through to Series B. We love pre-seed and seed stage investments. We tend to do our Series A and Series B investments as follow-ons. Investible also has an agnostic, we call it internally, but externally it's the tech fund, so everything but climate tech and biotech, who invest with a similar thesis here in Australia. We also invest internationally and have an office in Southeast Asia.
I'm Karen Chan. I'm a portfolio manager with Perennial Partners. Perennial is a house of boutique investment teams, and I'm sitting with the private investments team. We manage $700 million in funds under management. We are later stage investors, investing in private growth, pre-IPO, as well as selected IPO and listed placements. We're also in market raising a dedicated fund in the private growth space. Targeting companies in the various stages of growth, from early all the way to late stage growth.
Okay, well, thank you for that. So for our first question, have the markets are all showing signs of entering a recession? There may be some market that's not, but combine, the effects of increasing interest rates, inflation, the effects of the pandemic, war in Ukraine. The world's not looking like a great place, and people have been talking about comparisons of the 2008 recession. Who knows if that's true or not? So I wonder, taking these in order again, Jeb, coming from the US, you have a slightly different perspective on this, I think, from the rest of us, and you're seeing really probably bigger stuff, and maybe the US moves faster. But what are you seeing how are you preparing to face this challenging world?
Great question, Jenny. I came out of uni in '98 and went through the 2000 dot-com bust. worked as a mortgage trader for Countrywide in 2008 and actually sat on a subprime desk creating mortgage-backed securities. And I now have lived in Australia for the last 5 years, but once the border reopened, I spent 12 weeks here in Sydney and then 12 weeks in California and travel across the states. So I'm getting a pretty interesting perspective. What I'm seeing, as I'm seeing again in 2008, those that are over-leveraged are being crushed. They're being hurt by the drawdowns. They're losing equity quickly. Those that had reserves were being smart with the way that they levered up and stayed in cash or reduced costs to preserve cash are now looking at opportunities that is going to probably compound them again like we've never seen since 2008.
Okay. Now we have Ben, who just about wasn't alive then. I think you said you were at university.
Yeah, so I was 15 in 2008, so I wasn't on a trading desk. I was studying nice and hard. No, but I think maybe Jeb made a good point of perspective. So from my perspective, at Investible, what I'm seeing at the moment is still a lot of seed stage companies I'm seeing, and what I anticipate when I reflect on the 2008 recession, which I really didn't get involved in, was that we saw the Series A, Series B, Series C startup deal flow and the amount invested in those stages decrease. But that's when seed really emerged, these pre-revenue, very early companies. And what we're now seeing, and what I get to see now as the foot soldier, so to speak, is I get this opportunity to not have to rush a deal, rush an opportunity. I can look at an opportunity, I can dive deep on the founders, I can get to know them, I can send them questions, do proper due diligence, and that really has only really started to emerge in that light, that speed or that slowdown in the last few months. So I think it's a great opportunity now for these early stage investments because we can do higher quality due diligence and hopefully get higher quality companies in our portfolio.
Okay.
And from what I'm seeing, we keep a very close eye on what's happening in the public markets. So the public correction has flowed through to the private markets as well. And as Ben said, it's a really great time to be investing because I think founders are now a lot more realistic. And also in the earlier stages, there's just been a massive wall of capital that has come into the market, actually from the early stage all the way to the late stage. And so speaking to the early stage, that has really promoted and created a lot of new companies and innovation. And that just means that there's just more companies available for ourselves at Perennial to back, for example. So I think companies that Ben invests in, we can continue to invest in them as they reach our stage. And companies now are really more focused on not necessarily growing at all costs, but being more efficient with the use of capital. So I think we're going to see some really great companies emerge, just as we have seen, during recessionary periods, such as just right after the GFC, where some really great companies like Uber and Instagram were created over that time period.
So I guess I've been seeing there's a couple of trends that weren't there in 2008. One is just there has been a huge increase in savings in the world, increase in the amount in pension funds, etc. There's just a big increase in the amount of money for investment. And I was going to mention, there's another one I was going to mention. Oh yeah, and there's been a shift towards tech because everyone has just seen the massive success of the big tech stocks. And that's, I think, led to a structural shift in favour of investing in technology. So those are kind of two structural things that have been going on, making more money available in the tech sector. But on the other hand, you have all these recessionary things we were talking about before. So just thinking, thinking that bit of background, how it might be different this time. And I do remember talking to Steve Torso after 2008, 2009, maybe it's when we were doing a podcast together, and he said that what they found at Wholesale Investor was that the investing didn't slow down much in the first year, but it did in the second year. And he thought that was because the funds already had money and the funds were still investing. And then as the funds used up their funds, it was harder to raise funds. So the real slowdown came in the second year. And the message to companies, of course, is grab the money when you can. But I wonder if you're seeing that this time. Wait, should we go in reverse order? That's not fair on you. We'll start back with Karen.
I wouldn't. I would actually say that all the funds that I've been speaking to, they're still in market and looking to invest. I think what's actually changed is probably the cadence and the speed at which this capital is being deployed. I think Ben touched on this point. It was getting to the point last year where it was very frenetic in terms of having to sort of rush to, make an investment decision. So we're seeing companies really taking the time to really get to know the investors. And so there is definitely capital, but I think investors are just going to be a lot more disciplined in terms of pricing, as well as being a bit more picky. And in some cases, some investors may really just be focused on companies and sectors which they know very well.
Yeah, and maybe to continue on with Karen there, so just the speed now in which we can look at an opportunity. So when I first started as an analyst, one of the most frustrating things I would ever encounter was, we meet the founder, you like the founder, you build this relationship with the founder, another VC comes in, offers a term sheet at a huge valuation that doesn't make any sense, and they need it done by the end of the week, and we're too early in the process. There was all this hype and there was all this fear of missing out, and I think what we are getting an opportunity to do now is really go, all right, and as again to one of Karen's earlier points, this emergence of good companies coming out of the recession, where we see good business economics, good technology emergence, and founders really thinking about their burn rate. They're not growing at all costs. They're thinking about the measures they need to take to be operating at a profit. And we get the time now to test those assumptions and really engage the founders on a good level. We're still raising in our climate tech fund. We just successfully reached our second close. So we're definitely, maybe it's the climate thematic as well. We haven't seen a slowdown of the funding there.
Just compounding on that, I think given my corporate advisory and capital raising business focuses on emerging managers, I'm seeing first-time fund managers probably struggle more to raise those funds, where the marquee names that on fund 1, 2, 3, 4, and beyond, the KKRs and the Blackstones of the world, and even the mid-market generation funds still have a lot of capital that they have yet to deploy and are re-upping at enormous rates. And so there is a lot of capital that's going to be out there, but it is taking a lot more time to go out. One of my clients is in the VC space, and she's ex-Blackstone. And two of the places that she's deploying capital into, one would be SpaceX. They are allowing them much longer time to complete due diligence, to get term sheets out, understanding the percentage of capital they're going to be able to take down in that funding round, and being alongside some of the big partners like Chase's Tiger Global, et cetera. So there is, I think, a tremendous amount of opportunity that's still out there, and has been indicated a lot of time to do the DD on that now.
Jeb, I might just quickly jump in there, and I think I've sort of seen this too, where there are companies that are not short of investors that want to invest in them, but I think a lot of the investors around the table don't really want to make that first move necessarily, and so they'd be happy for an investor to step in and set the terms. But once those terms are set, a lot of these companies would actually have a lot of supportive shareholders, as well as other new investors that would be willing to come in as well.
So you've all talked about the deal process slowing down, right? Just more measured, time to reflect. What are you seeing happening to valuations? It's not so relevant to the fundraising.
Well, if it's an evergreen fund, no. But to the fundraising on a VC space, those valuations are coming down. I mentioned Tiger Global. They're down 47%, with a lot of that in private equity. So it is now following the public market. So you are seeing valuations come down to more reasonable levels. That VC fund that I mentioned, she has the capability to write private swaps and take take a short position, which is unheard of in the private markets, and she's been touting that for the last year and a half and raising capital to take what was overvalued in the VC space. And to what Karen was mentioning, I had just wrote a blog post mentioning that exact same thing, where I called it a Mexican standoff because I'm from Southern California, where we are seeing 3, 4, 5 investors that are all staring at each other, and you almost, as in the role that I fit, or as an IR rep, you have to kind of get them all to the table so that one of those dominoes falls, the other 3 or 4 come together. But it's almost that, or you have to have an anchor or a seed and give them preferential treatment. That's the way to get the deals done today.
People are scared to set the valuation.
Yeah, I think so, because they don't know. I mean, obviously, they don't preach trying to find the bottom, but they don't know if there's another 15 or 20% to go, or 2 or 3 to go.
What are you seeing, Ben? Valuations down?
I think the way to put it is, and all the founders out there who I do respect, it is shifting more to an investor market in terms of setting the valuation. So, we would frequently engage founders who, they were talking to a lot of VCs, they were getting a lot of term sheets thrown their way at various valuations. Of course, the founders quite often picked the one that was best suited to them. Now there is a lot more measure, there is a lot more waiting for the first person to make the first move. Particularly here in Australia, I obviously can't talk as much for the US. There's a lot of co-investing amongst VC here, and a lot of collaboration. So I wouldn't necessarily say it's always waiting for someone to make the first move and that's kind of coming out of nowhere. There's a lot of talk, there's a lot of consideration going, what does this founder deserve, what makes sense for this business? And yes, we are seeing the valuations drop a bit. From an investor's perspective, that means, we're putting in the same amount of money. We want to give them a good cash runway for the next 24 months. We want them to see them deploy it well. We want them to deploy it smart as well. But at the same amount of cash getting injected over the last 12 months as opposed to the next 18 months, this is really an opportunity for VCs, early stage investors, to really make strong returns over their next fund's life cycle.
And yeah, I'd agree that I think from a multiple point of view, especially in the later stages, given what's the market is trading at in the public arena, then the private markets would need to reflect or be tied to where those public market multiples are traded. But I mean, that's not also stopping some companies from raising at higher valuations. So it really is company by company, because some companies may have only raised like 3 years ago and they've actually shown significant growth. And on that basis, even if the multiples have contracted, they could still raise at a higher valuation. However, companies that raised last year may actually end up looking to do a flat or down round. So it really just depends, right? So I think even if companies do raise at a lower valuation now, if they are continuing to grow and have capital efficiency, and show a path to profitability, then there's no stopping them from being able to, recover from that and grow through that.
Okay, so some people have been talking about early stage valuations being down 40%, but I've also heard 20%. I've heard quite a variation. And I'm sure it varies sector by sector, and some things are harder to value. Certainly SaaS, where just multiples get applied, and you've had a relatively early stage SaaS company without a great established market position, some of those must be down 40%. Do you guys have any sort of metrics to throw around for us?
So I'm on the climate tech fund, so I can immediately dodge this one. We don't do too much SaaS investing. We look at the hardware.
Are you seeing valuations down? Can you say they're down 20% or something like that?
Really, at the stage we're looking, one of the key considerations we're making is not over-diluting the founder and ensuring there's a good ESOP allocation for the employees. So I've seen it myself with our investment committees, this consideration of actually the founder needs more capital, and we don't want to do it at the same money, because if we're considering the future rounds and the implications that will have on the motivations for the founder and employees, there could be negative consequences. So we have seen valuations drop a bit. I would say, we're seeing valuations, maybe the founder traditionally would ask for pre-money 7 mil val for $2 million on the round. We're seeing that maybe drop to 5 to 6 this time around.
Yeah, sort of amount I'd see. But you actually made a very good point there about making sure there's enough skin in the game or whatever, the founder's getting enough out of it. And I remember one of my very early learnings in VC was at some conference, and a guy from the US was asked this question, how do you value a startup? And and he said, well, that depends. That turned off most of the audience, right? But then he said, if you're a serial entrepreneur and you've built a business or two before and you know what you're doing and you want $1 million for your startup, he said, I might let you have 80% and I'll take 20%. But he said, you come to me with no track record, you don't know how to run a company, I'm going to have to help you build the team, I'm going to have to find out if you're any good as a CEO, I'll leave you with 20% and I'll take 80. And it's like a light went on for me. I thought, it's a joint venture, right? You're looking at a joint venture and what each of the parties bring to that joint venture and how you're going to go together over the next 5 years. And I think that's a really important point.
Definitely, and I would also add to that, there's also VCs, and this isn't us, but I know very well there's VCs out there who will only back first-time founders as well. So the thesis does change. I will say on the value you can bring to the table, though, startups are still looking, even at seed stage, they're looking for what support can they get outside of capital, and that's still very much part of the discussion. So what portfolio management support can we provide as a fund? They're not looking for someone to give them capital, wipe their hands, watch them drive off into the sunset. They're looking for those touch points, help finding good staff. There's still difficulty right now hiring, right? So what support can we give them through our networks, etc.?
Yeah, I'd agree. I've seen a bit of that too. I mean, sometimes we do meet with companies that are a bit earlier for us. So sometimes they might be asking for, let's say $5 million on a $15 to $20 million pre-money valuation. But then given that that's probably not something that they can achieve in the current market, then they might say, well, we'd be happy to raise 2 to 3 and maybe supplement at a lower valuation and then supplement that with other options such as debt.
Right, so the amount's down as well as the...
And that's just to, solve for dilution.
It's a good example. So another question though, how long do you think this is going to last? Well, and maybe part of that, is this the new normal? Like we were obviously in some sort of funding bubble before. Do you see this as a trough that'll last for a couple of years? Do you think things have settled down to something more reasonable? What do you think, what's your crystal ball for the next 3 years, say?
Do
you want to rub my head?
You could rub mine too. We're not too far off. Not being an economist, but coming through a few cycles, and what I'm reading a lot of, I think obviously the inflation was caused by just governmental response to COVID and lockdowns. We haven't seen, or I think most people haven't seen, normal rates. I mean, I remember my first mortgage was about 7%. My parents' or grandparents' mortgage was 20%. And so the fact that, we're sitting, I think my mortgage here in Oz, I'm on a 2-year locked at 1.9, and in the States at a 30-year locked at 2.8, something like that, that these are unnormal times. And I think given the addiction that we've all have to the liquidity that the central banks globally have been providing, I think they will reverse course in 18 to 24 months because we'll be in a deep recession.
Right, so you're seeing this, when it comes to the impact on valuations and availability of money, you think this is going to last for a while?
I think about 18 months before we see a reversal, okay, and then a step back where they start pulling rates back again.
Okay. Ben, go for it.
So I've been looking for the answer to this in my own journey, and I'm hoping 18 to 24 months, but I will say it's really difficult to navigate and find the response on this because depending on the commentary, there's a bias towards, one report saying, yes, consumer spending is up, we've overcome all the difficulties, the other one saying it's down. So I'm very much willing to listen to Jeb and Karen on this one, and I think you should too.
Karen.
Well, I'd say like it's always very hard to predict the future. We have already seen a significant correction on the public markets, and that has flowed through to the private markets. I think from the IPO window, which we look a lot, which we look quite closely on. I think that's sort of closed probably for the rest of this year. I will be a bit contrarian here, and I'd say cautiously optimistic that I think we could find a bottoming earlier than 18 months. But I think even if it does extend to 18, 24 months, which I think that is probably quite sensible given what we've seen in past sort of recessionary periods as well, to more recent history. And I think just given the levers that central banks are willing to pull if things really do go pear-shaped, I think then there would be more stimulus back in the market.
So one final question. You've all mentioned how for companies, they might need to come to you for a bit less money at a lower valuation, make it last, be sensible, and then come back for more when they've got more runs on the board. But what about for investors? What's the response for investors in the room? What would you advise them to do? Is it a diversification? Is it weighted out? What are you recommending to investors? We'll start with you, Karen, this time.
Well, I think diversification is important. Each investor will have different biases. At Perennial, we do like companies that exhibit high growth, and technology-enabled companies tend to have those characteristics. So I think it is important to maintain diversification, and for us, we do that also because we are focused on high growth companies, and depending on who you are, some people don't think growth is where you should be investing in, but we take a different view. But we are also looking to layer the liquidity windows for our investors, so we want to make sure that we invest in companies that are maturing at different times, so then we can also avoid market cycle risk. So there are some companies that may have an exit within 6 to 12 months, and then there are others that may take 5 years to exit. So we're comfortable with that, and I think having a bit more of patience and flexibility, then I think we will be able to ride through the cycle.
Okay, Ben.
To add to the points, in particular, so even with being on the climate tech fund, diversification is key. So we invest across the UN 6 sectors. At the moment, seeing a lot of hardware, do see a lot of software to enable hardware and infrastructure, etc. Ideas as well. I think right now for investors in seed stage or who want to invest in VC funds, who invest at seed stage, it's probably one of the best opportunities you're going to see. You're seeing the funds are able to not get caught up in the hype. I will hand over to
We're not countdown here.
It's red, and I've got 6 seconds, so I don't think I can really say much, except one of the PE funds that I do represent, I am seeing there across the retail space doing from apparel, perfume, sports equipment, etc. And I've seen co-investments now from an EBITDA perspective come way down to 1 to 2 times in that sector. So I think that's a massive retrench from where maybe they would have been investing in the past.
Well, thank you very much, everybody. We used up our time, and hope you all learned something.